most people should have an idea about LIFO, FIFO, and weighted average. I know a couple of students have mentioned before that they were struggling in understanding it. So it's going to be a pretty compact video where you guys will definitely also have to do a little bit more reading up on it. But LIFO, FIFO, and weighted average, as I've mentioned before, it is actually one of the main ways in people in different industries use one of these methods in regards to managing their inventory. At the end of the year or the end of a season or the end of the month, they need a count in regards to how much we have. And because they're buying product at different time, and when you buy at different time, you might get a different cost, it might be a little bit of a struggle in regards to saying how much is it valued. Different industries, as I've mentioned, use different methodology. I'll give you a perfect example. Those that use fuel, so if you go to the gas station, when they buy their gas, it will be at a different cost, but because it's all stored underneath the pump and it's liquid, they can't separate how much did we pay for the gas last week versus the cost of the gas that's coming in this week, because it's all blended up. So all petrol industries use the weighted average cost. If you're in probably the produce market, you might use the FIFO, which is first in, first out, because you want to definitely go in and say the older ones, you want to push them out or first before they touch the newer ones. LIFO, not a lot of industry uses it, but they do have some people who definitely uses it, especially if they want to hold on to like historic or couture or something where you want to hold on to the low cost. Neither here nor there. The takeaway from this is LIFO, FIFO, weighted average. LIFO is last in, first out. FIFO, first in, first out, and weighted average is a blend of everything that's going on. So what I do have, because I am a visual person and it involves a lot of math and it's hard to do math just talking, I do have a chart here. And what I'm going to do is a little bit of an example. So on this example where we're talking about, we have a store, Dr. Barnes' store. And basically I sell greeting cards, right? So for the greeting cards, on January 1st, I purchased 1,000 units for $1. And so the total is $1,000, right? So on January 10th, I purchased another 500 units, but this time it cost me $1.50 for these. So that is $750. How did you get to $750? That's the 500 times the $1.50. That gives me $750 for that purchase. On January 15th, I did another purchase. I purchased 200 cards, but this time it cost me $2 a pop. So that's $2 times the 200, that's $1,400. So that's the end of but at the end of the month, I'm saying I have 400 cards left. So based on math, because this is not remedial math and this is intermediate accounting, so you should have some math skill sets. If I have 400 left and I purchased 1,500, 200, that's 1,700. So based on math, I sold over the course of the month 1,300 cards. So with that settled, that is factual. Now depends on different method how much I can ask in the finals, meaning I will ask in the finals. I can ask, with giving you these information, please calculate how much is my overall merchandised inventory. That's how much inventory I have left, which is the $400, the value, the 400 cards, the value of that, and my inventory sold, which I overall sold 1,300 units. So just to be clear, the 1,300 units that I sold and the fact that I have 400 left, that's fact. That does not change. What we are going to discuss is what's the value of it. So using LIFO, which is last in, first out, let's go over this. So we're going to do bottoms up, last in. So what's last and it's going out first. So because we sold 1,300 units, we need to get to 1,300 going bottoms up. Okay. So is this a part of it? Yes. So we sold those 200 units. We sold those 500 units. So we're at 700. And we sold a fraction of this 1,000 because we are at 700 here. So we need another 600 that we've sold. So we sold 200 at $2, the 500 at $1.50, and 600 out of this 1,000 at $1 to give us our overall our inventory sold. So our inventory sold, here I have the math right here, gave us the $17.50. And our merchandised inventory, which is what's left over, would be either A, you can say the 400 that's left at $1, or how I like to do it is how much was my overall total cost, which was $21.50 minus how much I sold. All right, so that's how you use LIFO. So FIFO now, as FIFO is first in, first out, meaning that the first one we did is now a tops down. So we're still selling, we still sold the 1,300 units and we still have 400 left. It's just the value of it. So we're going tops down now. So we need to get to 13. So did we sell all this 1,000 units? Absolutely we did at $1. Did we sell all of the 500? No, we didn't, because we sold 1,300 and we sold 1,000 already. So we just need 300 out of this 500 here, which was at $1.50 to get to the 1,300. So that's where you see right here, we sold, that's 1,000, and the 300 at $1.50, which was $4.50. So our inventory sold was $14.50, and our leftover, we can do the $21.50 minus the $14.50. Now the weighted average, which is a little bit of a struggle for some people, and again, sorry for my handwriting, but I definitely want to get it. For the weighted average, it's one of the easiest ones. Some people struggle with it, but I think it's actually pretty easy. What you want to do, I'd actually recommend you do the weighted average the very first. You take the overall units that you had, which was 1,700, and you take the total cost, which was the $21.50, and you divide the $21.50 by the 1,700 units to get a blended cost. And that comes out to be about $1.26. So the $21.50 divided by the 1,700 give you $1.26. And now you have that blended cost of it. And how much inventory did you sold? You sold 1,300 units. So it's a 1,300 times $1.26. Some people have to round, and that gives you a number. And then you can either do one of the two things, the same thing that you did, your total, which was the 21.50 minus what you sold, or you can say what you have left over, the 400, and it's the 400 times your now weighted cost, which would give you 510. So the reason why I wanted to make this video again is you have to understand this math to understand that LIFO, which is last in, first out, is literally bottoms up. You're going from the bottom until you get to how much you've sold. FIFO is actually tops down. You're going from the top to actually how much you sold. And weighted average is actually a blend of the three. Now, for this week's discussion, it definitely discussed the inventory management. And you now, if you have any questions or concerns or not understanding this, please let us know. But again, please do your own online research on it. And I'm going to be a little bit more close so you can see the numbers. And again, I apologize for my handwriting, but there you go, right? And then there is LIFO. I did LIFO first, right? So you see we're doing LIFO, which is last in, first out. We're doing bottoms up. There is FIFO, which is doing tops down. And of course, now you have your weighted average, which is a blend of what is your overall that you have divided by the total cost to get a number. And then you just use that weighted cost to multiply by how much you sold and how much you have left. So that is the video. Please let me know if you have any questions or concerns, but your online discussion is due by the initial post by the 4th day of the workshop, which should be about Saturday. All right.